So I do Zoom every class. That's not so you can attend online, but I take every Zoom, I convert it to a YouTube video. So you have every class out there for reviews. You can go back and look at it. If you do get sick and you can attend, you can have a make up for 3 classes by watching Zoom and sending me your notes. You have to send me your notes. The fact that you're live on Zoom doesn't count. So you have to send me your class notes to prove that you actually watched the entire class. But you can, so 3 makeups is enough. So if you get sick, I don't need a doctor's order, a doctor's note, or anything like that. If a family member, you have to go to some family event, I don't need that. So you get 3. If you have some special case, I had one lady in my class, she was pregnant, and she gave birth during the semester. I think she missed 1 class. But stuff like that, yeah, I'm not an ogre. But I'm thinking for most people, 3 excuse absence is enough. If something special comes up, let me know. I do have athletes in the class sometimes, and so I kind of work around that as well. But 3 should be enough, right? Any questions on the attendance? Now I've seen someone's missing a lot of classes. I'm probably gonna let you know. I need to drop you from the class. Come to the point where you missed too many classes, it's just not gonna work. All right. Now I understand parking here is a pain. Did y'all have trouble parking?
Yeah.
It's pretty bad. So it's a pain for me as well. So it's pretty rough. I got a really good spot today, but normally it's pretty bad. I have to walk a mile. Y'all probably have to walk 5 miles. So I understand that. So you just have to work that out. But that's if the hardest thing at college is getting the class, then your classes aren't hard enough. The hardest thing in college should be your classes. All right. So if you can't get the class, then you're probably gonna have a tough time working finance. All right. So I won't put them out there immediately after class. Usually Friday. It takes me about 4 or 5 hours a week to get all the classes on the YouTube. So you can go to my YouTube. You can find my YouTube. You type Ronald Sweet in YouTube, my ugly picture comes up, and you'll find my channel. It has prior classes in there as well. So, every class I've ever taught the last few years is out there. So it should be recording, hopefully. Looks like it's recording. All right. So on attendance, it can add 2% if you have absolutely perfect attendance, and that doesn't include the Zoom. All right, I'll start taking attendance next Tuesday. So Laura being on a Zoom today doesn't hurt her, but if she misses next Tuesday, she doesn't get the 2% bonus. All right, so if you have perfect attendance, you can get a 2% bonus. I can subtract as much as 5% for attendance, but there comes a point where you're just going too far. I have students that I miss like 20% of my classes, and they're like, big deal, only 20%. I was like, well, in your first job, miss 1 day a week without telling them anything and see how long you work there. It's not gonna last too long. I know employers are fighting with working from home right now, and they're trying to get employees back to the office, but still, 20% is a lot of misses. And the core survey can add 1% if you just do it. What I don't have up there is the teams. So we're gonna do teams. You'll figure that out as we go. Did I do teams? Beverly, in your class, we did that, right? Oh, that's right. It was like down to the very last question, wasn't it? So did your team, whose team won? One of y'all's teams. Okay, all right. We still want to be on their teams. They're strong students, but their team didn't win last semester. So it'll be similar. Some of them will be team questions. You work together as a team to come with the answers. Sometimes it will be each of you answer independently and your group's individual answers. So on Thursday, we're going to do our first team question where you each individually answer because you won't know who your team is. So if you miss and you're absent, you're hurting your team because you're not going to be able to contribute. And the second half of the semester, most of the team questions will be exam questions. So you'll get to practice the exam. So if you didn't figure something out, someone on your team can explain it and you'll say, oh yeah, you explained that a lot better than the professor did, and that will maybe help you get some insight. I had one lady in my class, in this class, she figured out that if she studied for the team cases, her team would win and she would get a 2% bonus. So her team just started getting every week. And I noticed, I handed out the team question and she just grabbed it and answered it and turned it back in. So her team was just sitting there riding on her coattails. It was just like, I'm gonna get the 2%. I don't care what you guys do. So you can save your team and be the hero by just coming in and being prepared. And why not? Because you're gonna have to do it on the final in a few weeks later anyways. You might as well learn it and just do it. So, so that's not up here, but you can get another 2% bonus. I have people ask, well, how many teams can win? And the answer to that is 1. I think for your class, I gave the first place 2% and the second place 1% because in their case, there was like, it was real subjective how I was giving points, and it was like it could have gone either way. So I kind of had to flip a coin. But yeah, only one team can win. So the fact that you got 15.2 points and the first place team is 15.3. So you better be prepared every single class on the teams. All right. My office hours, the first week I'm not always there, but I can tell you every single morning, I mean every single morning I'm on a bike for 3 to 4 hours. I'm completely free. So if you want to call to talk about the class, you want to talk about careers, you have questions about the investment society, you saw a job posting, you've got a question about or whatever, you can call me anytime in the mornings. I start writing at 4:30 a.m. and write until about 9:30 a.m. So from 4:30 to 9:30. Now, once the weather gets warmer, I'll probably be writing from like 6 to 10 or something. But you can call me anytime. I'm always up here Tuesday, Thursday because I have classes. The first week, Monday through Wednesday, Wednesday, I'm not always up here because I don't have classes and it's kind of starting. But you can always set a time to Zoom with me so that you don't have to just use these office hours. If you want to meet with me by Zoom or phone, just email me, we'll find a time that works. But you let me know when you want to meet. I'm very flexible. But yeah, feel free to call me. I had one student called me every night, like at 10 o'clock, and want to talk about oil prices or whatever. And it was like, that was when I was still working at USAA. It's like, I gotta get to work in the morning, but you want to talk until like 1 a.m. I love talking finance. So if you want to do that, call me anytime. I've done a lot of career counseling while riding my bike. I might sound like I'm like really out of breath, and it's because I'm really out of breath. I do some pretty steep hills here, but I'll still talk to you anytime you want to. That's my email. Now, this is the part that's getting really, really tough. So if I get an email from you from Canvas, it's very different than Blackboard. In Blackboard, I get an email from Blackboard, it goes to my personal email and I can reply. I can't do that anymore. So I have to get in the habit of checking Canvas for emails. I do get your Canvas email through my personal account, but I can't reply to it, which means I got to get on Canvas, which means I got to go through all the dual stuff, and I'm on a bike and I'm sweating. I may not really get that to work. So I'm usually really fast at replying, but UTSA security is making it much tougher. So if you really want me to respond, your best bet is to email me directly at that account. That's probably the best because I check that all the time. Text, if you do text, I might respond quickly, but if I don't respond quickly, I'm probably going to forget that you texted me because I'm not really good at text. So email is better because I have like a work file in my email to know to go back to, or call me. So those are fine. If you email me at UTSA, it forwards to my personal email. So you might get a reply from my personal email. So memorize that. Y'all know what Mahler 6 is? Any Mahler fans in here? Anybody know who Mahler is? Did I tell y'all that last semester?
No.
Y'all heard of Beethoven? Okay, so Beethoven's like second class versus Mahler. Mahler is the greatest composer in the history of time. So he's my favorite composer. The Sixth is the Sixth Symphony. It's a great symphony. It's all about death and dying and tragedy. I love it. It's really good. It's not my favorite. The Ninth is my favorite, but I didn't want to get a new email account. So Mahler 6. So that's easy to remember. You see Mahler 6, what other professor is going to use Mahler 6? Anytime I email to a musician, they're like, oh, you got a really cool email account. So great. I got a Mahler fan out there. Go out and listen to Mahler. If you're going to listen to Mahler, don't start with the 6th. Start with the 2nd. The greatest one ever. That's just blow you away. And there's my phone number. All right. So the projects, the papers are out there. So we're going to spend the first several weeks working on a template. And it's a template that essentially just says, how do you organize the investment world? You probably know there's stocks and bonds, right? Y'all seen that before. You know what stocks and bonds are. I said I was head of equities. So what's the difference between equities and stocks? We'll talk about that. In fact, my title in my department, I was VP of equities. Really bad title. I should have been VP of stocks. There's a difference between stocks and equities. but they call me VP of equities. It just sounds cooler, right? Than stocks. But anyway, so we're going to talk about those. We're going to do some phrases you might not be familiar with, like convexity. Y'all know what convexity is? Modified duration, those type of terms. You probably didn't have that in 3013. Is that your only class so far in finance? Have you had another finance class? You've had some discounting cash flows and that type of thing. So we're going to cover stuff it's organized. I think is a really good template. I had UTSA was interviewing on campus right before our first exam in this class. And they asked the question that I asked them, essentially is the first question in this exam. They asked the question, if I inherited $500,000, what should I do? That's what the question on this exam is. Those students came back to me and was like, wow, we really aced the interview because they had this lengthy answer. I saw the lady from USA afterwards. She was like, yeah, I was taking notes as fast as I could, not because I wanted to hire them, but to go home and manage my portfolio better because they were really impressed. So it's a very common question. There's like 3 questions you get a lot in interviews, and this is one of them. Someone walks in at $500,000, how would you advise them? That's a sense of the answer. How do you organize that answer? I do this. I just created a wealth management class on YouTube, and it walks you through the same type of template. Not quite as complex as we do in this class, but that same type of thing. I was at a party with a bunch of retired USAers at it, and one of them, Paul, walks up, hey, Ron, you remember me? I go, yeah, and he introduces his wife to me, and she says, oh, you're head of equities. Should I buy gold? That was her first question. Should I buy gold? What's the answer to that? I'm like, wait a minute, I got to figure out some things. Why are you buying the gold? What are you investing for? What is your risk profile? What is your goal? What else do you own? Those kind of questions. He's asking, is gold overpriced or underpriced? I don't know. No one knows the answer to that. But so she didn't ask the question correctly, so I couldn't answer the question for her. So we're going to do quite a bit of time there. Then the second half is stuff that you probably had in 3013 a little bit. We'll get a little bit more detail in it and try to make it more usable so you can actually do something with it. So that's how the class works. We end up with one of my favorite topics, which is derivatives. And then we have the second exam on December 7th. Your first paper is due September 30th, but you can start working on it after the first Friday of September, whenever that is, because that's when the economic report comes out. Very unrealistic. In real life, the paper will be due 30 minutes after the report came out. So in real life, your boss is going to call you and she's going to say, hey, I have a meeting with the CEO at 10 o'clock. The important report comes out. I need a paper on my desk when I walk in. So that's normal, right? I'm giving you 30 days, not 30 minutes. Okay, so I'm giving you a lot more time so you can practice and kind of get into it. The second paper is due in November, but you can probably start working on that earlier than that. It's an earnings release. I'm actually going to pick the companies for you because I need to find a company that has an earnings release and it's an interesting release. So I don't want a company that said they're expecting to make $4 per share and they made $4 and a penny. That's pretty boring. All right. I need a stock that's expecting $2 and they made $3 and the stock's up 50%. That's the kind of thing I'm looking like. Zoom. Y'all see Zoom this last week? Just kind of surprised the markets. Or did y'all see NVIDIA earlier this year? That was pretty amazing, wasn't it? You probably wish you had NVIDIA in your portfolio. So that's what we're looking for. So I'm looking for companies. And if you have ideas, you see a company you're interested in, let me know and I'll look and see, and I'll get you the data. And then the last paper is you can pick any company you want with a few constraints, and then you're going to value the company over 2 papers. And the nice thing there is I have an entire YouTube video where I do that entire paper, but I do it for Walmart, which means you can't pick Walmart. It walks you step by step how to do evaluation. You did some of that in 3013, but in 3013, it was probably more multiple choice questions. Wasn't it? One thing I hate about finance classes is they give you all the hard stuff and they ask you to calculate the easy stuff. Like this company's beta is 1.4. Where did that come from? Is that the right beta? Guess what happens when you get your first job in finance? Do you think your boss is going to say, hey, I want you to value Apple for me. Their beta is 1.4. They're not going to say that, are they? What are they going to say? Go find a stock for me to buy. They're not going to even give you Apple. They're definitely not going to come up and say, hey, I'm thinking about buying Apple. Is it worth A, $100, B, $200? They're not going to say that, right? I remember I started off in accounting. My first 3 years was accounting. Great first job because every minute of the day I knew what to do. And then I took my first job in finance. Boss, what am I supposed to do? He said, well, look at your job description. My job description said, make USAA better. I said, okay, well, I'll do that. No instruction whatsoever. I created my own job. Fortunately, Lisa was there, and Lisa was really nice. We're still really good friends today. Her and her husband are in New York City now, but thank goodness she was there. And she was like, here, Ron, I'll help you know what to do. Because, in fact, my first assignment was, he said, oh, next week, all the cash managers, all the treasury managers at USAA are coming in for a meeting. You have a 30-minute presentation to teach them how to do treasury management. And my question was, well, what's treasury management? So, well, you better learn fast. So, finance is incredibly ambiguous. If you can't just create your own job, you're gonna, so you got to be able to think on your feet. So, so I'm going to take it so that you actually have to come up with the hard stuff. You got to figure out the beta, the discount rate, the growth rates for your stocks. I'm not going to give you that because that's not how it works in finance. All right, any questions on anything I've done so far? The paper one discussion, once the report comes out, we'll talk about it in class. I'll give you some insights. I'm actually going to collect some of the data you need to make sure everybody has it on that day. So I'll be helping you some. We even have probably a team question on it to make sure everybody understood how that report came out. But we're going to do it on the employment report, probably the single most important economic release that comes out. We'll see. Boy, we've had some interesting ones. What do you think people are interested in on the employment report? So what is an employment report? What are the two numbers they give?
There's the ADP report, and then there's the
okay, so ADP we're not doing, but yeah, that comes out a couple of days earlier.
yeah, and then there's the private.
So payroll, so that's what we're gonna do, which is a number like 300,000. How many jobs were added? What's the second one? So ADP comes out a couple of days earlier. So you got number of jobs.
Oh, and there's the labor turnover and the quits and labor turnover. I forgot the exact acronym for it.
Well, the main one I'm thinking about is the household survey, which is the unemployment rate. Right, that's the number that's really low right now, right? Almost historically low number. So you got the jobs report, which is primarily they interview corporations and ask them. A household survey, they call households and they ask them. In fact, I was in the survey. The labor department called me and said, hey, do you want to be part of the household survey? And guess how quickly I answered yes. I was like, sure, I'd love to do that. And so I was doing that for several years. So they come to my house, and this guy, I'm like know this guy personally now. It's been so many years. And if I'm not there, he leaves a note. He calls me. They're going to get me to answer the survey. He's not giving up on me. And when he gets me, he asks, did you work last week? If I say yes, he's kind of done. If I say no, he said, did you want to work last week? All right, that's important because if I'm retired, I'm not unemployed. All right, and I don't know, Kyle, you might be hinting at the participation rate. So the participation rate is certainly an important one. Participation rate is, I didn't work last week, but I wanted to. Or I didn't work last week. I didn't want to work last week, but if I could get a job, I would. So that's someone who said, I've just given up. I really wasn't looking for, I'm not unemployed, I've just given up. So what you'll notice, you're gonna have to write about the participation rate because it's gotten much lower since COVID and it hasn't gotten back up. There's a lot of people just given up. A lot of people retired because of COVID. They said, I'm just not gonna work anymore. A lot of people went back to school. When you're in school, you're not unemployed, right? Because you're working. But once you graduate, then you could be in that number. So you got to understand those numbers. So extremely important number. I know if I've been successful in this class, not if you check the report at the beginning of September, but if you also check the report at the beginning of October and November and December and 20 years from now, right? If you're a finance major, guess what you're going to do the first Friday of every month? You're going to check your employment report. This is just a big part of your life. So we'll talk about it and get into it. let me give a little bit more discussion. We'll get into it more. But here's the description for paper one. You really can't do much until the report comes out. It comes out actually on September 1st, so that's good. But you can start reading ahead. I give you some links in this paper. This econday.com. You go in there and look at their calendar. You can look at prior reports if you want to and just see what's going on. So there's ways you can start reading ahead, getting used to it, and not used to the terms. So we'll get into it. We'll talk a little bit more about it in here. Now, Kyle mentioned the ADP report. One of my students was asking me, why is the ADP so different than the jobs report? Sometimes it's strong and the jobs report's weak. Sometimes it's weak. And so I recommended he maybe go back and do a historical analysis and see how correlated they are and when did they diverge. And just try to figure that out, because the ADP should be real similar to the jobs report. They're doing the very similar things. So I'm not you could put the ADP in your paper, but you want to find something else. The ISM comes out that week. That's a pretty important report. The jobless claims comes out that week. That's a pretty important one. There are other things that come out. Now, which do you put in your paper? Well, what's important? The ISM comes out and no one cares because it hit exactly what was expected, and maybe you don't put that into your paper. Okay. Now, what should your paper look like? Let me give you an example. So Beverly and JJ and Brandon, this looks familiar, doesn't it? So I've gone to this format in the last several years. What do y'all think of this format? Would you be embarrassed to have your name on that kind of paper? It looks very professional, doesn't it? A student of mine many years ago, Jay, he's doing great now at Merrill Lynch, but he turned in the paper and looked just like this. And I go, wow, that looks really, really good. Where'd you get that? He went to the Financial Analyst Journal, professional journal for finance, and he just copied their format. So if you're going to put something out on LinkedIn, you don't want to be one column. And I beg of you, never type a double-spaced paper again for the rest of your life. There's nothing that looks more like a college student paper than a double space. Now, why do you double space? More pages, right? So you don't want to do that. It looks so, when I see a double-spaced paper, I just like, okay, college student time. It looks horrible on LinkedIn. Try to imagine that versus what this looks like. All right. So what do you have? Well, the first thing he has is, title and then an abstract of some kind. The abstract can be, this is what I'm going to do in this paper, or it could be a summary of what he's saying. So like on the earnings report, you might say, NVIDIA came out with earnings on X date, and the market had a very strong positive response to it because they beat. And you might even say they beat because AI or whatever. Just real quick, and then you get the paper. Or I could just say, in this report, I'm going to discuss the employment report that came out on Friday and how the markets react. Something that lets your reader know, why are you doing this? What's your goal in the paper? And then you have good titles. So you know right where you are. As I tell students, the best titles, if you really want your boss to read something, you have a title that's a question. So how do the markets react is much better than market reactions. How did the stock market react? For some reason, psychologists have studied this. This is true for internet links as well. People click on questions more than they click on statements. You ask your boss, how did the stock market react? And she's like, yeah, how did it react? She's like, yeah, I want to know the answer to that. It's just for some reason our brain clicks on that kind of stuff more. You have some bolding in there to help lead your reader to where you want to focus in on. I don't like massive tables like this. This is the employment report. So it's everything in the employment report, but it's a lot of data there. Some students put the ISM in there. That's even much more data. If you're going to put the ISM report in, you might circle the parts you really want them to focus in on because it's just too much data. One thing, I don't like the way they did it here. I actually prefer that you center it, and they're a little too narrow. So you notice when you do two columns, you want to have very, very narrow margins. Don't use 1-inch margins. But if you have a quote, you want to italicize it, separate it, and then I like to center it. But they made their margins too narrow. So, just kind of links it into that. But if you have a really extended quote, don't put a long quote inside a paragraph. It's just really hard to read. Now, if it's a quote of like 3 words, yeah, you can leave that in a paragraph. But if it's 3 or 4 or 5 lines separated out, looks very, very professional. Graphs. The best kind of graphs, the title of the graph tells your reader why you put the graph in there. What are you trying to say? So, impressive improvement in employment. That's what you want them to look. If you can't do that in the title, then maybe add an arrow with a block, a text block that says, hey, look here, this is where I want you to focus. Maybe your focus is we're back to where we were before COVID. If that's the case, then you can kind of point at pre-COVID and where you are now, just so your boss sees that. See, like here, they did the ISM. They highlighted the manufacturing sector because that was the biggest driver for jobs. So certainly that makes some sense. They found a really good report online. You do have to put the source in there. That is important. And good titles throughout. They use Bloomberg charts. Now that looks pretty messy, doesn't it? But actually putting a Bloomberg chart into your paper is really good. Because then people know you know how to use Bloomberg. I don't know how many of y'all have a Bloomberg account in there. Kyle does. It's going to take me 4 minutes to figure it out. Cody. Kyle and Cody. Anybody else? Okay. Ryan. Okay. Brandon, you do. Yeah, Brandon was teaching a class last semester in investment studies, so he was in that room. All right. There's several things you got to get on your resume. One is you got to get this profile built and this portfolio built, the papers. You got to know Excel, obviously. It used to be that's all you had to know. But the list has gotten much longer. You got to know Bloomberg. How do you get Bloomberg on your resume? Well, the Investment Society will teach a Bloomberg class this semester, so you could do that. Or you just go down to Bloomberg lab and just do Bloomberg Market Concepts. You can do that from home. Any of y'all doing Bloomberg Market Concepts? Kevin has. I did it during breakfast over about 2 months. So you can do it pretty quickly. It's actually pretty good. You can put it on your resume that you have Bloomberg Market Concepts. So that's the second one. You got to learn Capital IQ. I think it used to be Capital IQ. No one talked about it. And then suddenly about half my students that were out there in business, like Victory Capital, they use Capital IQ. So you got to learn Capital. How many of y'all have a Capital IQ account? I know y'all 3 do because I'm required to do. I'm almost liking Capital IQ more than Bloomberg. It's a really good competitor, so that's pretty good. So you got to know that. You got to know something about AI. The best thing you can do is find a good AI podcast and just start listening to it. The CEO of NVIDIA, I like what he said. Maybe I do or don't like it, but he said AI is not going to replace jobs. No, it's going to people who know AI are going to replace people who don't know AI. So do you have to be a programmer? You probably should start thinking about how many of y'all know Python in here. So a couple of y'all, so that's good. Manual, you learned it on your own or did you take a class? Like from Coursera. Coursera, yeah, I've done some of those classes. So now do you use it on a regular basis or? I mean, that's the tough part, right, Kyle? Kyle, do you use it on a regular basis? Yeah, that's a tough thing. I learned Excel because I was using it probably 8 hours a day. People used to come watch me do Excel because I got so fast, but it's like, man, you're just sitting here doing this all day, you get really, really fast. If you think I'm fast on Excel, you're way behind. All right, I'm a dinosaur. So it used to be well beyond where I am on Excel. But Python is a machine learning database. I saw one of my students in New York. He's a decision science working in New York, and he uses Python all the time. So yeah, I mean, it's you don't have to learn it, but probably 25-30% of our alums are using Python in finance on a regular basis. I have some that don't use it at all, so you don't have to, but it is an advantage. Coursera, it was free, right? Emmanuel, you did the whole thing free, or did you get a designation at the end?
UTSA pays for it.
Oh, do they? Maybe you could help us know how to do that. That's pretty good. Code Academy is another one. There's probably a few others that do that. You might at least do a Coursera or Code Academy Python. I mean, the first lesson is Hello World, right? That's the first thing you start with. So just so you can say you've taken some classes. You say, I'm not an expert in it, but so they at least know you're a self-starter. The best thing though is get an intern where you use it every single day. When you do something every day, it's pretty easy for you. Power BI and Tableau. Any of y'all use those? But you use it like an intern. Yeah, so that helps a lot, right? You learn it pretty fast, right? Those are pretty, you use Power BI or Tableau? Tableau, yeah. So I think you can use Tableau here at UTSA. I don't think you can use Power BI. So you got to get your resume, get those things on your resume. Your interns help a lot. So if you have a boss that'll let you use Python on an intern, that helps. Obviously, you can learn Excel, but you gotta, if you can't do that, you gotta do what a manual did. You just gotta teach yourself. You just go out and take the class. All right. So Bloomberg's one of those things you got to learn. It's pretty easy to learn. You can teach it yourself. You do have to be here to use it, but the Bloomberg market concepts, you can do that on a video from home. I think it's better to do it here, bring earplugs and do it here so that when they show you something on Bloomberg, you can then do it on the Bloomberg machine yourself and just test it and see how it works. So having Bloomberg charts in there is great. The very end, I like having a final summary. This student didn't do that. He just kind of finished the paper. I like to have a final summary, but the final summary should be really short. Some students mess up their final summaries like 7 paragraphs. They just repeat everything you've already said. That's not good. So you want to somehow get right to the point. But it's up to you to come up with your writing style and figure out how you're going to do it. These templates are out there. So if you want to use them, I'd recommend you find something that looks like it could be published. This looks like it's something that could be published as professional as you can make it. All right. So don't just stick stuff on LinkedIn. Make sure it looks good. Forget about page numbers. I mean, this one went on quite a while. Now you notice on the sources, I'm not real picky that you use the full-fledged sourcing that UTSA library requires you to do. So you can get away with, just giving the link. The key though is if your boss has a question, you've got to be able to find that source. And links, internet links tend to change over time. So be careful. If all you have is the internet link, then, can you find it? And I had one boss, he needed a source. He also had to know the date that the source said what they said. That's not so important in this first paper because obviously you're talking about the employment report. They said it probably the day of. But the date someone says it can be important. Who said it, those type of things. So make sure you have, documented enough so you can go back and answer questions. Now, why do they have quotes in here? So you're starting your first job in finance. You've been out of school for 3 months. Does your boss want your opinion? Yes, she probably does. But would she maybe want the opinion of someone who's been working in this field for 20 years? That might be more important. So your job might not be to give your boss your opinion. It might be to find what the best experts are saying. And the best thing you can do is find some insight no one else has seen. All right, I have some of my favorite websites. If you want my reading list, it's out there. It has podcasts and some other places that you can go to. I love GMO. GMO has some of the best, and you can go to gmo.com and register, and they have some of the best articles out there. It gives you insight no one else is thinking about, and they actually write it like that. This is why we think the market's wrong. This is what we're seeing everybody else isn't going to see. So when you're writing a paper for your boss, if you give her, remember, she's got a meeting with the CEO at 10 o'clock. And she knows the CEO is going to ask her about the employment report. She wants to be able to say something creative. Is she going to give you credit for it? No, but that's okay. All right. I always tell students in your first job, you have one goal, and that is to make your boss look like a genius. Your goal is not to get her job, because she'll notice that and you won't do well at all. Your second job, you can get your boss's job. Your first job, you just want to make your boss look like a genius, and whatever you can do to make her look smart, she's going to back for you the rest of your career. So you're trying to find ways to give her insights so when someone asks her about this report, she sounds really brilliant. Even though it's your brilliance and she's taking advantage of it, that's fine. That's what you want to do. So I just mentioned Bloomberg. The best thing you do on this report is go to the Bloomberg lab, type AD, and watch videos where they're talking about the employment report that day, because Bloomberg is going to interview the best people in the business, people with the best insights, and you can quote them. You're looking for those type of insights. All right, so we'll get into this more. All right, so we got a few minutes here, so let's do this real quickly. There's the S&Ps. So what did the stock market do today? So you say S&P 500 was down 0.28%, or 12.2 points to close at 4388. I mean, you can round it. Down 0.8%. Now we need one other thing. We need an adjective. Yeah, we'll probably have to wait till Tuesday. Was it down significantly? Down slightly? Does 0.28% sound like a lot? And marginally is not a bad word. So you give the percentage that it's down, the points that it's down, and then closing them out. All right. And you need an adjective in there. Now, what adjective? I'm going to show you this next class. How do you know the adjectives? So I'll give you a trick. It really helps a lot. The daily standard deviation of the S&P 500 is a real easy number to remember. It's 1%. Y'all remember standard deviation? So 2/3 of the time, it's between plus and minus one standard deviation. The mean, the daily mean is 0. So 2/3 of the time, the S&P is between plus and minus 1%. So what if the S&P was down 3%? Would that be a big day or a small day? That'd be a big day. That's a pretty rare event, maybe a couple times, 3 times a year. So 3%. When I was working at UTSA in September of 2008, we had days when the market was down 10%. Was that a big day? Yeah, a 10 sigma event, you put that in Excel, and Bill Gates says that's impossible. It cannot happen. 10 sigma events do not happen. So that was a pretty big day. All right, so you remember that 1%. If you have an interview on a day, the market's down 2%, you better know that, so that when you walk in and say, wow, what did you think about the markets? You can say, yeah, the S&P was down 70 points, man, almost. You sound intelligent, know what's going on. All right, let's try another one then. All right, so there's only one interest rate on Yahoo Finance. Y'all know which interest rate that is? 10-year Treasury. The most important interest rate there is. So here's the 10-year Treasury. Now you got to talk very, very differently. I won't even ask y'all. Some of y'all might get it right, but so Yahoo Finance does it entirely wrong. All right, there's only one number up there you can actually quote. Let me give you the quote and y'all can see if I can figure it out. Treasuries. Oh yeah, basis points is good. How many was it? All right, very good, Kyle. So, all right, great. We're up today as yields fell 1.4 basis points to a closing yield of 4.33%. So first of all, I don't talk about percentage change. That percentage change, 0.33%, means nothing. You would never use that number. You also notice the minus 0.014 is in red. It should be in green. What do bond prices do when interest rates fall? Go up. So bond prices actually went up. All right. So you don't talk about the percentage change. When you talk about an interest rate, you don't talk about percentage changes in interest rates. That's why we use basis points. Now, if you want to sound really impressive in an interview, you don't say the Treasury yield was down 1.4 basis points. You say the 10-year Treasury is down 1.4 bips. Right? That sounds a lot more jargony. So yeah, the Treasuries are down 1.4 bips today. They're going to be really impressed. You don't sound like a college student anymore. So, but 1.4 basis points. And then you get a closing yield. You notice what I didn't give was the price. You can't give the price because there isn't a 10-year treasury. There's a bunch of them. So what is this? They went out and looked at a bunch of treasuries that mature in about 10 years. Some of them might have a coupon of 5%. Some of them might have a coupon of 2%. They're going to have prices all over the place. So you can't talk about the price. So all you can do is say that the price was up or down. So the treasuries were up. As yields were down, yields fell. And then you get the closing yield. All right. So you don't give the price. You don't get the percentage change in anything. All right. So that's how you talk about anytime you have an interest rate. You're going to see this on paper too when you talk about margins. A margin is a percent. You don't say Walmart's margins were down 12%. You say Walmart, well, or 1.2%. You say, or what? I can't think margins right now. But you say they're down 50 basis points or 100 basis points. All right. So don't talk about the percentage change in a percent. Same thing with CPI, inflation. Inflation was up 25 basis points. Right. It gets really confusing if you say inflation was up 0.25%. Because you don't know if you're talking percentage change or you're adding 0.25% to the rate. So it gets really confusing. All right. So with treasuries, you talk about basis points, the direction of prices, and the ending yield. Now you notice with the S&P 500, I did not put a dollar sign there. We don't say the S&P closed at $4,000. All right. It's an index. You just get the index. All right, so what else do we have here? So let's go back to, let's try gold. Oh, that's oil. All right, let's do oil. All right, so oil was down slightly, 0.58% to close at 80.25, but here you can use a dollar sign. Right? Commodity prices, you can use dollar signs. There's one thing I forgot to tell you on Treasury, so let me go back to Treasury real quickly. So the S&P 1% is the daily standard deviation. What about Treasuries? So I'll just give you this number. We might try it again on Thursday to see if it's changed much. But 6.5 basis points is 1%. 6.5 basis points. All right, so 1.4 basis points is not that big of a day. So here you could probably say treasuries are up slightly. Whoops, not yelling at you. We're up slightly today. Why? Because 1.4 basis points. Not much. Now, back in 2020, during COVID, we had some 40, 50 basis point days. That's massive. All right. We had actually some record days back in 2020.
Maybe about a month ago, that's like 40 days.
Yeah, I might show you what happened during March Madness. It was pretty crazy. I might show you that when we talk about inflation. We have had some pretty crazy days. In the last month, it's been horrible. I texted my friend at Victory Capital. I was like, can you bond guys just settle down? Because it's been horrible this last month. All right, so if you're talking about a commodity, you do this percentage change just like you do with stocks, but then you use a dollar amount. All right, you don't have to say how much it changed. So, you know, with stocks, you say it's down 12 points. Y'all notice that word. Stocks are down not 12 basis points, but down 12 points. Treasuries are down 1.4. The yields are down 1.4 basis points. But oil is down. You don't have to say it was down $1 or whatever. You just say it was down percent. Okay. Now, if you go into an interview and you say the S&P was down 28 basis points, that's correct. But they're not going to be impressed. They're going to think you're trying to show off by using basis points. All right, and that's never good. All right. So the S&P is down 0.28%. Say it's down 0.28%. All right. Don't throw in basis points just to show off. When you get to treasuries, yeah, that's where you can use BIPs and say treasury yields are down 1.4 basis points. So what will you use on your paper one? Well, I don't know. It depends on what happens. If oil prices are down 0.58%, then it's probably not something you need to talk about because that's not all that important. Oil prices could be down 5%, but it has absolutely nothing to do with the employment report. So you have to check on that as well. How can you tell? Well, an unemployment report or employment report comes out first thing in the morning. If oil fell in the last hour of the day, probably something else drove oil prices down versus the employment. All right, so you have to kind of check and see. So I'm not going to tell you what to put in your paper, but we will talk about it in class. What are the kind of things you could put into a paper? So you kind of see where paper one's going. I'm hoping we had a crazy report. So what are markets really focused on right now? So the big debate has been hard landing or soft landing and inflation. So the unemployment report is somewhat of a lagging indicator. It's not a forward one. So it's kind of telling you where we've been, but there are inflation numbers in that report that are pretty important. Our employees, because we have a shortage of labor, our employees demanding higher wages, and you're starting to see that in inflation. So there's a lot of stuff you can work with. We don't know what it's going to be. I'm hoping would 400,000 jobs added be a big day or an average day?
That'd be a big thing.
That'd be a really big day, wouldn't it? What about 200,000 jobs lost? Any negative number is going to be a big number. All right. So that's what the market's looking for. You mentioned ADP. The ADP and the jobless claims give us some kind of hint if things are trending poorly. So it's not a complete shock when we see it, but we have had some pretty shocking reports in the past. So, all right, I'll let you out early, 5 minutes early. It's the first day. We won't do a team exercise on this next class, but we will next Tuesday. You can see what it's going to be, right? The team exercise. I'm going to give you the markets, and you got to tell me what they did in those terms. Okay?
Is it going to be the one day for individual?
Individuals are right, yeah. So we want to talk a little bit more about markets just to get comfortable in how you say it, how you express it. And then we'll get into that first exam question on portfolio construction, the why, what, how, and start getting into asset classes. So yesterday was an interesting market. There's the S&P 500, the 10-year treasury, crude oil prices, and gold. One thing when I look at a market is what is it telling me? So stocks and bonds are the primary thing we focus in on. We may talk about this a little bit more. The normal thought process, bad news, bonds are up, stocks are down. Good news, stocks are up, bonds are down. Why? Because bonds don't like interest rates rising. Usually a strong economy, rates rise. There's more inflationary pressure. That's the norm. And so you look historically, and bonds and stocks provide good diversification to each other. Normally, as I like to ask my risk class, are stocks and bonds positively correlated or negatively correlated? And the answer to that is yes. Yes, they are. But the question is, when are they positively correlated? When are they negatively? So in normal times, they're negatively correlated. Good news, stocks up, bonds down. Bad news, stocks down, bonds up. That's the normal. In 2022, stocks and bonds were both down 20%. That sounds like they're positively correlated. What happened in 2022 that was unique? What was everybody talking about in 2022? Inflation. When do stocks and bonds move together? During inflation, they're done. So how did stocks and bonds do in the 70s? Horribly. Why? A lot of inflation. How did they do in the 80s? Great. Why? Because inflation was coming down. So normal times, stocks and bonds are great diversifiers. If you're helping your uncle with his portfolio and all he has is stocks and bonds, you can say, Uncle, you're well diversified, except an inflationary scare. And that's what happened in 2022. Stocks were down and bonds were down, both 20%. So bonds really hate inflation. So what happened yesterday? Stocks were up. What were bonds? Don't say down. What were bonds yesterday? They were up, right? Because yields were down. So yesterday they were both together. I might show you the chart one of these days when we get into stocks and bonds, but during March Madness, so last year stocks and bonds were both down. March Madness, we had 8 days where stocks and bonds were really volatile, and every day stocks were up, bonds were down. Every day stocks were down, bonds were up. So I looked at that March and said, okay, stock market and bond market are now no longer focused solely on inflation. They're now focused on hard landing versus soft landing on the economy. So yesterday's pretty interesting where you had a big rally in stocks and a big rally in bonds. That's not the norm. Usually you can see. So what happened yesterday? So was there some good news on inflation yesterday? That's kind of what you might interpret. So how would you express this? I don't know if anyone who didn't talk on Tuesday might want to, so that you walk into an interview, you say, yeah, they say, hey, you notice the stock market? And you would say, yeah, the stock market was what? Anybody want to try it? Okay, Beverly?
The stock market was up 48 points for 1.1%.
Good, good. So up 48.5. You probably could just say 48 points. All right. And use the word points. I couldn't hear you if you said points. You might have in my hearing's not too good. So the stock market was up 48 points or 1.1%. I usually give the closing amount. Obviously, in an interview, if you had that memorized, they'd be really impressed. But you know, Beverly probably would round it up. It's over 4,400. So you know, if that 4,400 is kind of an important kind of milestone. So yeah, so the S&P's up 48 points, 1.1%, closing at 44.36. Can we say $4,436? Would you say that? No. Indexes, we don't use dollars. It is a dollar, but we just don't say dollars for the index. All right, what about crude oil prices? We'll try that one. So oil prices being down, that sounds like an inflationary issue. That's good for inflation, isn't it? So oil prices being down. Based just on the right-hand side, what do you think the dollar did yesterday? Did it strengthen or weaken?
It's strengthened.
Yeah, that's kind of a tough one. I don't actually even know. So anybody, if someone look it up. So usually gold and the dollar do what? Go in the same direction? Or when gold's strong, what is the dollar probably doing? It's probably weak. But if inflation's down, what is the dollar probably doing? Probably strong. So that's a pretty tough chart. So I don't even know. I didn't look at the dollar yesterday, so let me look it up. Now in 2022, gold was flat. It didn't help you at all, even though we had all the inflation. Why? Because the dollar was really strong last year. So it gets really confusing when you look through this. So not only you have to know what these markets are going to do, you have to understand the interaction. That's where you're really, really providing great insight. All right. So what did oil prices do? Anybody want to try that one?
Yeah, oil prices were down marginally about 1.3% at a low price of $78.58 per barrel.
Yeah, so you can't say $7, $8 there. Now you said marginally. What word did you use?
Yeah.
Or is it Beverly? What adjective did you use? An adjective?
No, I didn't. I was just healthy.
Healthy or strong? Yeah, that's a pretty good rally. In fact, I told y'all 1% was the standard deviation. The standard deviation is actually 1.1%. So that is a 1 sigma event. Now, Kyle, you said, I think that's a pretty good drop in oil prices, 1%. I haven't done the standard deviation on oil prices. It's probably much more volatile than the stock market, so that's probably not a 1 standard deviation event, but that's a pretty good drop in markets. What about gold? Essentially the same thing, right? Gold was down $20. I mean, gold was up $20 or 1.04%, closing at $1,946. So we do know gold prices. So that one's interesting. How volatile is that? Gold prices are really volatile. So a 1% probably isn't a 1 sigma event. All right, and the hardest one. Anybody want to tackle the 10-year treasury? Not Kyle again. I'll let you if no one else does. Anyone want to try it? All right, Kyle, go for it.
Yesterday, the 10-year treasury prices rose as yields fell approximately 13 pips.
13 what?
Pips.
Dips, okay. So, and then give the closing yield. The closing yield.
Oh, yeah.
And close at
approximately 4.
How often did he use this number? Never. You don't use that number. So 13 basis points. So is that a strong rally or a weak rally? That's a 2 sigma event, right? We said 6.5 is 1 standard deviation. That's a 2 sigma event. 13 is a big event. My friends at Victory Capital, they were really happy yesterday. That was a great day. I almost texted my friend there and say, hey, finally, you guys turned it around, but then today it's off again. All right, so I'll say it slowly, so if you want to write it down. So on Tuesday, I'm going to give you this. and your team, but individually, you're each gonna write it, but you'll be in there for your team. You're gonna write, depending on what the S&P does, you're gonna write the S&P 500 was up 48 points or 1.1% to close at 44.36. Y'all get that? Y'all need that again? I'll say it one more time. The S&P was up 48 points, not 48 basis points, but 48 points, or 1.1% to close at 44.36. Don't say 110 basis points. That is correct, but that's just not the way we talk about the stock market. Right? Oil prices were down $1.06, or 1.3% to close at $78.58. Now, what's the challenge of this oil price? You need to know which oil price it is. What's the two choices?
It's either Brent crude.
Brent or
WTI.
WTI. And I can't remember Yahoo Finance which it is, but it's one of those two. So they're generally real close and highly correlated, but they are off because of storage, right? There's more, one's more Europe and one's more US, so it depends on storage capacity.
Your question about the DXY, it closed down yesterday, but then today it pretty much recovered.
So yes, if the dollar was down yesterday, that I think gold has gotten much more sensitive to the dollar. So I think that's why last year you would have thought gold would have soared with all that inflation. But the dollar is a big deal for gold. The dollar strong, gold just doesn't do well at all. Now, I don't know how Bitcoin did last year. They talked about Bitcoin being kind of digital gold, but I don't think Bitcoin's quite established what it is yet. All right. Same thing with gold. Gold was up $20 or 1.04% to close at $1,946. So we talk about dollars on oil and gold because they're in dollars. We don't use dollars for the S&P 500. You get the closing on all three of those. You get the percentage change on all of those. The S&P, you talk about how many points changed. For commodities, you talk about the dollar change. And then the last one, the 10-year treasury. The 10-year treasury rallied strong with yields falling 13 basis points with the closing yield at 4.2% or 4.198%. That's a strong rally. So you need an adjective. I'd probably say, healthy, strong rally for the S&P 500. Crude oil sold off materially. That's a pretty good drop. Gold rallied strongly, up $20. Find your adjective. That's what you have to do for paper one, is figure out what adjective you want to use given how big the change is. So let's talk about that change.
Can you say the 10-year treasury one more time? So
well, I usually start off. So the exact way I would say if I was walking the interview, I'd say, yeah, bonds rallied today. The 10-year treasury was down 13 basis points. The yield closed at 4.2%. I would probably say that. So I say bonds. Now, is that true? How many bonds are there? Well, that's the 10-year treasury. We're going to talk about that. There are short-term treasuries. There's longer-term treasuries. There's corporate bonds. There's high-yield bonds. Can I just say bonds rallied yesterday? Well, with that kind of yield change, yeah, probably every bond out there rallied yesterday. But I kind of generically say bonds rallied, and then they go right to the 10-year treasury. Now, if it's only 1 or 2 basis points, then yeah, it's a good chance corporates would have done the opposite. So to me, I think it's really interesting. 2008, treasuries rallied and corporate bonds sold off dramatically. So treasuries, I kid you not, there's treasuries that are up 30, 40% in 2008. And corporate bonds were down 15, 20%. In 2022, treasuries are down 20%, but corporate bonds are only down like 10 or 12%. So bonds are not bonds. They can be very, very, very different. 2008 was one of the worst, probably the worst year for corporate bonds. I compared it, I actually did analysis when I was at UTSA, how 2008 corporate bonds compared to the Great Depression. And my analysis showed, if you compared corporate bonds to treasuries, my analysis was 2008 was worse than the Great Depression as far as that differential. Is a huge, huge, huge differential. But I do generically say the 10-year treasury represents the bond market, even though there's a lot of differentiation within there. Now, getting more comfortable with that, Brian?
For oil, why wouldn't you say it's down 1 point to go 6 points? When you say it's down $1.06.
Well, that is $1. That is the actual barrel price of the oil. There's WTI or Brent. That is the actual price. If it's a commodity, I use prices. I use dollars. $78, $19,946.
And what additive do you use for the oil?
Well, I don't know how volatile oil is. I wouldn't say it crashed. To me, a crash might be 5, 6, 7%. So you might do what I'm about to show you is go get oil prices and calculate the standard deviation.
Okay.
Same thing with gold prices. They're both probably much more volatile than the S&P 500. So I doubt that's a one signaling event. So I don't know. I don't follow gold and oil that closely to know what their standard deviation is.
You just say it's up, like, is that acceptable, or is there another term that's more descriptive?
Well, if someone says gold's up marginally, I would say that's not strong enough. If someone said, hey, yeah, gold's rallied strong today, there's a strong rally in gold today, I think that would be appropriate. 1%, that's, 1% is pretty good. You're pretty happy. If you own gold, you're pretty happy you're up 1%. There's no rules on these adjectives. I've seen articles when they use the word crash for like a 1% drop. It's like that's not a crash is like 10%, 20%. Crash is when you're in the streets crying. 1%, that's pretty normal. So let me show you how I do this. So I brought in the S&P 500 and I brought in the 1-year treasury, the 10-year treasury, and also did the spread, the 10-year minus the 1-year. So I brought all of those in. For the S&P, this daily standard deviation is 1.09%. So one sigma event is essentially 1.1%.
Oil, I looked it up, the daily standard deviation.
2%. So twice as much. Yeah, so those are good numbers to know, right? You almost have like a cheat sheet in your wallet or purse, so you can just say, hey, I know what a normal is. As I was telling Joseph, Joshua, part of this is just knowing when a number is big. It used to be shocked. That hey, wow, that's a really big deal. So anything more than 1 or plus or minus 1% is fine. Now you might say, well, isn't the normal curve mean minus the number of standard deviations, standard deviation? Well, what's the mean of the S&P 500? On a daily basis, yeah, it's like 3 basis points. It's essentially 0. Or 4 basis points. So, 0 is essentially it. So plus or minus 1% is a pretty normal day for the S&P 500. Now, if I put NASDAQ in there, what would that be? More volatile or less volatile? More volatile, right? If you remember, well, you don't remember because you weren't alive, but 2000, 2001, yeah, much more volatile, and especially 2022 and this year, that's been the entire market. They sold off a lot last year, and they're up a bunch this year. Now you look at treasuries. So there's the standard deviation of the basis points for the 10 years, 6.52 basis points. So we saw 13 basis points yesterday. That was a pretty big event. Now, if you go back to 2020, we saw some huge days in 2020, especially around March. I wrote an article on Facebook, and essentially what I know Facebook is, I don't know what's going on, but the bond market's telling us there's something big going on. And the bond market often moves faster than the stock market. There's a 17 basis points day at 20. Look at those 4 days. You had a 10, 18, 20. What is the bond market doing? Someone in here has Zoom on and all right, thanks. So what did the bond market do those 3 days? Rally or sell off? Huge rally, right? And then what did it do the next day? Sell off. Huge rally, sell off, sell off. Huge rally. That is a very volatile bond market. The forward bond guys are like, where are we going here? But a lot of uncertainty, right? When you have that kind of uncertainty, there's probably a good chance the stock market was doing the exact opposite thing on those days. It was selling off and the bond market was rallying. You see how you kind of get your money. You see a negative number, that's a good thing. All right, so you have to get used to interest rates falling, that's a good thing. The other thing you're interested in is the spread between 1 year and 10 year. The median is 92 basis points. So typically, on average, or 50% of the time, the 10-year treasury is 0.9% or 92 basis points higher than the 1 year. So if the 1 year is 4%, the 10-year will be 4.92%. That's normal. So what we call that a normal curve. That's a normal. So I would have that 90 basis points in your mind. The 10-year is normally 90 basis points higher than the 1. Where are we today? Negative 105. So what do we call that? Inverted yield curve. What is that telling us? It's usually a sign of recession, 6 months out. And we've been inverted for quite some time, haven't we?
Not like a whole year now.
Yeah, I mean, it's been pretty extreme inversion. Going from a really steep, we went from a really steep yield curve to really, and you go back to 2019. We went from really steep to really steep to really flat and negative really fast. So what's interesting about 2019 is it started going negative at the end of 2019. So the bond market started talking about a recession in 2020. Now we had a recession in 2020, but it was caused by a pandemic. Did the bond market know a pandemic was coming? Probably not, but it's kind of amazing they predicted that recession. So this is so I do the distribution 5%, 10, 25, 50. So 102 basis points is like 5% event. Right now at 105. So we're at a kind of a 1 in 20 year type of event. So this is a pretty negative yield curve, but we have been much more negative. And why were we much more negative? Well, because 10-year rates really have risen quite a bit. So you can see how negative we were. We got really pretty extreme. And here's the graph. This graph might help you a little bit. So here's a recession. See how negative the yield curve spread was? Here's 2 recessions. Y'all remember in 1980? Who caused those 2 recessions? Anybody remember? I mean, not remember. Volcker. Those are the two Volcker. He caused 2 recessions. Why did he cause 2 recessions? Inflation was 13, 14, 15%. I remember when I graduated from UT Austin, I had a CD because I lived at home with UT Austin. You may want to guess what the hourly tuition was in 1985. Any guesses? What do y'all pay for hourly tuition? For class, per hour, what do you pay? You probably didn't pay $4 an hour, I would guess. So if I took 15 hours, $60. My books, I remember one semester I bought books for all my classes. It was over $100 and it really upset me. I can't believe I'm buying books over $100. So it was really cheap, but inflation was really high. But it's so cheap that I saved money. So I actually had a certificate deposit, but it matured. I just took it, and the guys at the bank says, well, we can roll it over at 15%. I go, 15%? No, I don't want 15%. Give me a better rate than that. So we were turning down 15% high quality, low risk securities in 1985, 86. So yeah, 2 big recessions. How did Volcker do? Pretty good job. I read his book. It's an interesting book. He passed away right before he published it. Here's the Bush recession. Here's the .com recession. Here's the 2008 crisis. What do you notice about these last 2 major events versus today? The bond market is much more inverted today than they were. And those were pretty serious events. Yes, the bond market's today telling us something else is going on. So you should know these kind of things. So when you go into an interview yesterday, wow, there's a good strong stock market rally, good strong bond market rally. Gold was strong. So that's kind of unusual because the markets were rallying because inflation is not very good. Why did gold rally? So we now know because the dollar sold off. So that helps you understand that. Yield curve is still very inverted. So the bond market is still telling us a recession seems to be in play. You've got a lot of data just in one day worth of data. So you can do the same thing with oil prices, the gold prices, with the dollar. You can put the dollar in there. Comments in the DXY. The DXY is a really good index. You can get it off of Bloomberg, and it kind of combines a basket of a lot of stuff. My brain is so mixed up now because I'm so used to the pound being a 170 and the euro being 140, and the yen, I can't even figure out the yen anymore. All of it's so backwards now. I mean, I should fly to Japan. I've never been to Japan, but everything's cheap now in Japan because the yen has sold off so much. So the dollar has really done well. It's kind of sold off here recently, but really done well. But understanding those things, just knowing them, really helps you in an interview. And the reason it helps you is one of the things everybody interviews students, they tell me, is they want students that are curious. They're not a finance major because they need a job and make money. They're a finance major because they love finance. And this is how they test your curiosity. If you're talking about markets currently, because they know when you go to class, your professors are like 10 years behind. Because you got these textbooks that were published. If you're talking about current markets, that gives them a clue that you're interested in finance outside of just the textbooks, and that helps you a tremendous amount. All right, so you can see how easy that is to do. I got these out of Yahoo Finance. You could probably get oil prices out of Yahoo Finance. Gold prices, maybe not always can you go back that far. The Bloomberg machine has all of this stuff, and you can dump it into Excel really, really quickly. Like the DXY, you can get that very easily out of Bloomberg. Any questions on all of that or comments? Are there other factors you should be watching? And there's three right there: the stock market, the yield curve, and then the spread. What about corporate spreads? Talk about that. Where are corporate spreads today? Are they unusually wide or narrow? We'll get into that. I'll show you some numbers on that. I got a file that you can use on Bloomberg to bring all that data in really, really fast. So if you're interviewing with Victory Capital, which is a bunch of corporate bond people, it'd be really nice to know if the triple B spread is wider than normal or narrower than normal. You could do that in a nanosecond going on Bloomberg and just looking. So there's things you can do to really prep yourself for interviews. Y'all want this file on Blackboard? I mean, Blackboard. Well, I'll put it on Blackboard, and good luck finding it. But Canvas, I'll try to remember to put it out there. So what is the market doing today? I haven't looked in a few minutes, but the S&P was down a little bit, like 0.8%, right? Bonds were off a little bit today, so a little bit of unwinding from yesterday. All right, let's talk. So we're in question one. This is the question where you'll get in an interview of saying, hey, someone inherits $500,000. How would you help them with that? That's essentially where we're going. So what are you going to do? You're going to help them build an investment portfolio. So last class, I used the word portfolio related to LinkedIn. The portfolio on LinkedIn is not investments, it's your work, your projects and your papers from your college work. It's a portfolio, collection of things. So an investment portfolio is a collection of investments. It's a collection of assets. You notice I didn't use the word securities. So all securities are assets. Are all assets securities? So there's a difference there. Assets is the bigger group. Securities implies that it's traded on a public market somewhere. Stocks are securities, bonds are securities. What about real estate? Real estate is not a security. What about real estate investment trusts? We'll talk about those. That is a security that buys real estate, but it's a traded security. So assets, we're not talking just securities, not just stocks and bonds. We're including real estate and commodities and those other things. They're held for a particular future purpose. So last class I mentioned the wife of a guy from UTSA. She comes up and says, should I buy gold? Well, why are you investing? You're investing for retirement. You're investing for your college, for your kids. You're going to buy a house. Why are you investing? Gold might make sense if inflation's a concern or US dollar is a concern, and yeah, gold can make a lot of sense. So what purpose are you investing for? It could be retirement, could be education, house, leaving money to your heirs. There's a person here in town. He's from India. He's already started 2 companies, sold them both. He's worth tens of millions of dollars. So now he's trying to figure out what to do with his portfolio. I've talked to him quite a bit about it. And he has certain portfolios he wants to leave to his children. And so we're asking, how much risk can you take with that? You don't need to live off of it. You're still healthy. They're really young. And so my suggestion is, hey, if you're leaving it for your heirs and you don't need it, you should invest it the way they would invest it. Because it's essentially their money. So what are they investing for? How would you invest that? So you have to kind of think about that. So there's a really, really important word there. The word future implies time. So I'm going to use the word horizon. What is your horizon? I think that's probably the single most important thing. If I'm doing an investment portfolio to put a down payment on the house next Tuesday versus I'm doing an investment portfolio to put a down payment on the house in 20 years, I'm going to invest very differently in those two portfolios. If you have $100,000 for a down payment on a house, and you need to make it next Tuesday, you're probably not going to stick that in the stock market. Because if the stock market sells off 10%, you're not going to be able to make the down payment on the house. You're probably going to put it into what? A checking account, a money market account. You're going to keep it pretty low risk. If you're doing a down payment for a house in 10 years, you probably could put some of that in stocks. So the word horizon is really, really important to this. All right, so there's your investment portfolio. So someone comes in and says, I have $500,000. You got to figure out why they're investing. All right, so there's really 3 questions you have to ask them. And that is the first question is why? What is your goal for this portfolio? So the guy that came to me, he says, well, some of it's for my retirement, some of it's for my kids, some of it's for this. Okay, we need to treat each one of those separately because they each have a different goal, different risk. So why are you investing? Why does the portfolio exist? One of the reasons I retired in 2009 is I was head of all these mutual funds. Well, the mutual fund, I don't know why anybody's investing. They're just in my fund. I don't like that. That's not my world. My world is give me a liability and I'll find a portfolio that funds that liabilities. That's called balance sheet immunization. That's my forte. That's what I did my whole career. And then suddenly at the end of my career, I got all these portfolios with no liabilities. I don't know why anybody's investing. I just know they're buying stocks. So I prefer the world where I know why I'm investing. What's that future cash flow that I'm trying to provide a portfolio to fund? Is it sensitive to interest rates? Is it sensitive to inflation? Is it sensitive to the economy? That's what I'm asking. So that future purpose, I call it a liability. I call retirement a liability. What is a liability? Some future cash outflow. What is your retirement? Some future cash outflow, right? You're going to have to fund your own retirement. So it's a liability. So what assets should you have to match that liability? What would you think is your biggest asset on your balance sheet today? Who's in my life insurance class? Riley, you're in there, right? So what do we talk the biggest asset you have? You remember that term? It starts with an H, if that helps.
Oh,
Human capital. Oh, yeah, Elizabeth was in there. Yeah, human capital. Yeah, so your human capital is what? It's present value on your future income. That's an asset. So that's your biggest asset. That asset is really sensitive to what? Well, it depends on what kind of job you get. If you're a school teacher, what's it? You're going to lose your job because the stock market crashes or going to recession? Probably not. Pretty immune. So you can put all your money in the stock market. Why? Because you have this huge asset that looks a lot like a really safe bond. Okay, so that's your biggest asset. Well, how do you consider that versus your other investments? So most young people have all their money in stocks. Why? Because they have all that human capital sitting there. It's a very safe asset. They're probably going to be okay most of the time. So those kind of things you have to ask the question about. Once you figure out why you're investing, ask what drives that liability. So for retirement, there's 4 things that drive your retirement account. So let's see, you guys are like 22, so your parents are 40. So your grandparents are about to retire, aren't they? Y'all have grandparents that are already retired? Some of y'all, okay. But most of your grandparents are about to retire. They're like, I retired at 46. So many people retire at 46. But your grandparents probably retire, what, around 65, 70, 80. Depends on how well they save for retirement. So what risk do they have? Well, inflation is a big risk. If they retire and inflation takes off, their expenses in retirement will be a whole lot higher than they expected. The next one, real important, longevity. Y'all know what that is? You think of a risk of living too long, you outlive your portfolio. My life insurance class, we're gonna talk about a hedge for that. There's a really good hedge for that the insurance industry does not sell. I love it. It's one of my favorite products. I'm hoping one of my students will graduate and start a firm that sells this product because at USA, I tried to get it patented. My boss loved it, but I couldn't convince the actuaries. I think it's a great product. So make Riley and Elizabeth, I'll show you all that in my life class, and then y'all can start a firm. But there is a product that does that, but the insurance industry refuses to sell it. So, you know, what do? You live too long? Well, Social Security is pretty good for that. Because when does Social Security stop paying you? When you die. So that one's a good protection. It also pays inflation. So Social Security is a pretty good protection, but Social Security may not be enough for your retirement. So,
I would argue it stops paying when they run out of money, like 2028. I would argue that they stop paying when they run out of money, it would be like.
Well, for you, I don't know what you're gonna assume for Social Security. I'm assuming I'm gonna have it. We'll see. I'm gonna delay it till I turn 70 so I can maximize it out because I don't really need it. But yeah, we'll see. My mom's Social Security is $1,800 and her assisted living is $6,500. But fortunately, she sold a house in Austin, so that's her entire retirement, plus me. I'm her other retirement. But yeah, so that's her retirement. Yeah, $1,800 and it's costing her $6,500. Yeah, Social Security is not enough to pay for her bills. With assisted living, 60. How many of y'all are paying rent $6,500 a month? That's pretty expensive, right? I know what the dorms here are. They're probably over $1,000 a month, and they're not $6,500. So, so if she lives another 20, 30 years, she's going to run out of money, and then I'm going to be her retirement at that point. But those kind of things you have to think about. Yeah, once you run out of money. Interest rates, that's a big one as well. Interest rates is simply that when interest rates are higher, every asset class earns more from that point going forward. So you have a higher earning portfolio that's going to help offset that retirement. If interest rates are higher and inflation's higher, those two somewhat offset each other. You can earn more on stocks and bonds when rates are higher, but you have to earn more because inflation's higher. So they all kind of work together. The other risk for corporations, like USA has a pension plan, the risk USA has is you can lump sum that pension plan out. So I had that option at USA. I could take their pension plan or I could get all of it today. So what's the risk for USA? Well, if you're really, really, really sick, you don't think you'll live very long, what are you going to do? You're going to take that lump sum. You're really, really healthy because that pension plan is really good. It's got an inflation protection. It's a really good plan. You might take their pension plan. So they have what they call anti-selection risk, which is the healthy people take the pension, the unhealthy people take the lump sum, and they end up spending a lot more money than they thought. You don't have that risk. You get to anti-select against them in that way. And Social Security is somewhat similar. So someone like if I'm healthy, I can delay my Social Security because they increase my payment if I delay it. So what happens with Social Security? Unhealthy people are going to do what? They're going to start drawing at 62 or 65. Healthy people are probably going to delay it. So that's a risk you get to take advantage of. So most of you are probably going to handle retirement. That's what most people are probably saving for. You do have, you graduate, get married, you have kids. You do have college they save for. So how do you save for college? College inflation has been really, really, really high. I don't understand textbooks. What are y'all paying for textbooks now? Over $100? You're paying more for one textbook than I paid for 21 hours worth of classes of textbooks. That's why I don't use textbooks. What any of y'all spent? What did you pay? What are you spending over $200 a book?
I think it was the program, like,
Yeah, it's online now, and it's still $200.
like page, all of that, but how does this be for?
How many of y'all would spend $150 for a book outside of college? You wouldn't. It makes no logical sense. The Economist had an article on it. I was so excited. They were going to explain why are college textbooks so expensive. And the article never told you. Essentially, they said, we have no clue. I was assuming McGraw-Hill made all the money. They said they don't make the money. It's like, well, it's the authors. The authors don't. Well, someone's making money somewhere. So I don't understand that. But yeah, inflation for a college education. How do you do that with your kids? You might say, hey, I'm paying for your UTSA college. In fact, there's a kid I've been mentoring in high school. I'm hoping he's going to come here. I told him, this is what I'd tell your mom but don't tell her I told you this. And he goes, well, I'm on speakerphone and she's driving. So, okay, well, too late now. But I said, what you should do is tell them, I'll stay here in San Antonio, go to UTSA, and all that money I'm gonna save you, you pay me a salary for being a college student. Because it would save them probably $15,000-$20,000 a year. Say, hey, I'll stay here, go to college, you pay me $10,000 to be a college student. That sounds like a pretty good deal, doesn't it? Save your money, and then you don't have to work as a college student as much because you get that salary. So I don't know what he's gonna do, but that was my idea. And then once you know all about your liability, then you go find investments to mitigate that. You see why I didn't like mutual funds. I didn't have anything under that first part. I just had a bunch of people investing money with me. So my forte at USAA was life insurance portfolios, PVC portfolios, pension plans. I love that. That was really my thing. So how do you figure all this out? You sit down and you ask the person, try to figure out what they're doing. Now, one thing people talk about here is your risk tolerance. People with high risk tolerance, they can take a lot of risk. They're going to buy more stocks. People that don't like risk are going to buy fewer stocks. There's a big problem with that. You can try this. Go online and type in risk tolerance questionnaire, and a bunch of them will come up. And when you answer them, I don't know if I have one out there. Yeah, I have to show you one. Maybe next class I'll show y'all one. I hate them. I think it's a scam. I remember at USAA, USAA has had a risk questionnaire online, 6 questions. So I went in and answered it. I don't know how many combinations it was a bunch. I answered every single combination to see what asset allocation they would give me. And so then I went with the financial planners and I asked them, who's researched USA's risk questionnaire? And they said, oh, it's very scientific, Donald's analysis. Okay, that sounds good. That wasn't true, but that's what they told me. I said, well, you realize if I answer B on this question instead of C, my stock allocation goes from 70 to 50. Does that make sense to you? And they're like, no, it's right. Don't worry. It's like, yeah, there is no science behind this. Completely unscientific. Can you ask someone a question and figure out their risk tolerance? And what kind of questions did they ask? Well, one question they asked is, if the stock market sells off a lot, would you buy more stocks or get out of the stock market? So in a year like, say, oh, I don't know, like 1999, the stock market's been up for a decade. When stocks have been up for a long time, you ask a person, if the stock market sell off, would you buy more or sell? Most people say, oh, I'll buy more. Yeah, I love stocks. I'll do it. And then you have a year like 2008, the stock market sells off. You ask them that question. What do they say then? Oh, I'm getting out. I can't take it. What do risk questionnaires do? They get people to buy more stocks when the stock market's been doing really well, and then buy less stocks when the stock market sold off. What should they do? The exact opposite. What do risk questionnaires get people to do? They get them to buy high and sell low. They're horrible. I hate them. I think they're terrible. And why is that? Because people change their answers based on what the market has recently done. It's just a terrible, terrible model. So I don't like them. I think they're terrible. I think USAA should have just done away with them. But that's one question. Another question they ask is horizon. What is your horizon? I like that question. That makes sense. You got 20 years versus 10. You can do more in stocks. That makes sense to me. The third question they ask is your knowledge of markets. Now, why would that matter? So their assumption is people who understand markets better can have more stocks than people who don't. I don't know if that's all that true or not. I think part of the thought is if you don't understand markets, the market sells off, you're probably going to panic sell. But I know people who know markets that panic sell as well, so I'm not sure that helps. So the only question on questionnaires that makes sense to me is the horizon question. The other ones to me, there's no science behind it. It doesn't make any sense. I had this debate with Barclays. They have this booklet where you go into the booklet and depending on what answer you give, they say, go to page 16 or go to page 7. And I was telling him, these questionnaires are meaningless. And he said, okay, Ronnie, I have a secret. You promised not to tell anyone, so I'm going to tell all of y'all because I'm retired, so I don't care. So you should go through the booklet, and what you'll discover is there's only one question that matters, and that's the horizon question. Based on the horizon question, everybody goes to the same point. It's all smoke and mirrors. It makes it look like it's sophisticated and we're doing all this analysis, but it doesn't matter. Once you answer the Horizon question, that's where you're going. I said, okay, that's fine. I don't like lying to our employees, but that's fine. That's what we do. So they're in my boat, but they want to pretend like they weren't. Why? Because financial planners get real sensitive about this. Because they want to say, hey, we're charging a lot of money. We got to be doing something for you. And this risk questionnaire, that's what we do. Complete fake, but makes them feel good that they're doing something. So I'm probably stepping in some toes. You know, you want to have a public debate on this, I'll publicly debate you on it. But I just do not believe in risk questionnaires. But go try one, see how it works. So your risk aversion, the risk aversion of those questions that the market sells off, how you do. One big problem with these questions that I noticed with USAA is there's 3 questions that were essentially asking the exact same thing. And so I asked the financial planners, what happens if they answer these 3 questions inconsistently? That should maybe have you kick the questionnaire out, but it didn't. It gave me different asset allocations. So one was like, if the stock market sells off, would you buy more or less? The other one was, gave me a distribution of the market and asked me what I would do. It's like, those are the same questions, just with one with a picture, one without a picture. If I answer those differently, then I'm obviously not understanding the question and it should kick it out. But anyway, you can, don't have this debate as an intern, all right? Because you want that permanent job offers. So be careful. The people are sensitive about this. I think Horizon. So on the exam, I want to see the word horizon under the why question. What is your horizon? I do think that's the most important of all of those questions. You talk about risk tolerance. I think there's ways you can talk about it, try and get it to help them understand what they're going to do. I think possibly one thing I do that's worked real effectively is I have a way of buying markets. There's one lady at USA, she's a cousin of a good friend of mine. She was on this insurance side. She took care of all my insurance. And so I said, I'll take care of your 401k. And in 2008, I had a way to do it where she would buy on all the major dips. And I had her so focused on this formula that she was calling me all excited and going, I got to buy today, and thinking, well, you just lost 5%, but okay. But in 2009, she did extremely well. She was buying on the dips and she wasn't worried about losing the money. So somehow I got her distracted enough that she was doing, so it works really, really well. I've given this to several people. If you're interested in it, come meet with me. I'll show you how it works. The guy here in San Antonio, he wanted me to do that for him. And I said, I really don't want to do that, but I'll show your financial advisor how to do it. So I sent them my spreadsheet. I do it with stocks and bonds. So on the yield, I had another buy point at 4.3 on the 10-year treasury where I'll put a little bit more on duration on my bonds. So I think it can be a way to get people out of the habit of panicking. You start getting them thinking, hey, if the S&P hits 3,000, I'm going to do this with my stocks. So they're kind of anticipating like, oh, great, I get a point to get in the stock market. I was kind of out of stocks at the beginning of 2020, and I just thought they're kind of expensive. And when the pandemic hit, that's what I did. So, okay, if it hits this, I'm going to go in. If it hits this, I'm going to go in. Unfortunately, it didn't go as low as I was hoping it would. So I didn't get fully back in. So I got like back 70% back in. But still, I was buying on all those dips to get back into the market, and then it came back so fast. So there may be ways to get people around that panic selling. I ran USA's 401k plan. I can just tell you, back then they mailed out the statements every quarter. I would look at them and I could call whatever number was the highest. I could call that manager and say, you're getting $300 million tomorrow, just letting you know. Why? Because the employees would look, whatever had the highest return, they would move 100% of their money to that. Just ridiculous. What are they doing? They're chasing returns. That's not the way to do it. It's a horrible way to invest. So I'm going to argue, if you don't know what you're investing for, you know what drives that liability, I'm arguing you can't invest. You've got to understand that piece of it. That's the why question. Any comments, anything to add to that? Do we have any financial planners in here? Interns? Yeah, don't read my blog on this industry. Unless you want to have your toes stepped on. I don't like that industry. Poor Riley and Elizabeth, they're gonna hear my view on the life insurance industry, which I hate even more than the wealth management industry. I don't like the wealth management industry. I think they grossly overcharge for overly simplistic products that are overly complicated in the wrong ways. I just think grossly overcharged for what they do. I was working with one entity here locally. I essentially told them, fire your financial planner and just go to Vanguard. They're not going to do it because they're too scared. But they're paying over 1% for something that's worth not even 0.1%. They're wasting a lot of money. But why do communities do that? Because they don't want to be sued. Like, we know it doesn't work, we know it's a waste of money, but at least it's off our plate, we don't have to worry about it. Like, you can get a much better result. You're gonna do the exact same thing they're doing, but you'll save the 1% and you get to keep all of that. But they want to do it. So I can't convince them, but I tried. No comments on this? I don't mind stepping on your toes. I actually like that. So if I'm at a restaurant and I see you at a table, you don't know I'm there, and you say, you won't believe what my idiot professor said, I'll be really happy. If you're worked up about this class, I love it. Okay, where are we on time? We're good. Okay, the what question. This is where we're going to spend most of our time. What can you invest in? This is what we call your asset allocation. So we're going to be spending a few weeks on this. This is the most important part of the class. We call this, have you used the term asset classes before? Asset categories. What asset categories are there? Well, we could go crazy and have every single asset in the world could be an asset class. So Apple stock could be an asset class. Microsoft stock could be an asset class. A debt to General Motors could be an asset class. Every single, so we have 100, 300,000, every single piece of real estate, every house in the United States could be an asset class. And you could bring in all your assumptions for all of that, millions of pieces of data, and figure out the optimal allocation. That sounds like a lot of work, doesn't it? Do you think you could come up with an expected return on every house in San Antonio and its risk, how it correlates to all the other houses? That would be a lot of work. We could just have two asset classes, stocks and bonds. That seems a little too limiting because I mentioned treasuries are a lot different than corporate bonds. So how many asset classes do we have? So I found an article by William Sharp. Y'all know who William Sharp is? Y'all heard of Sharp? Y'all heard of the Sharp ratio maybe? William Sharp, he's known as the father of modern finance. He's a Nobel Prize winner in economics. He wrote a really famous paper about what? AJ knows, Beverly knows, Brandon knows. What did we talk about last semester? It starts with a C. First three letters sounds like something you put on your head. Capital. Oh, manual, you were in there. All right, I should have picked on manual first. So the capital asset pricing model, y'all remember that from last semester? Most important theory ever written in the entire history of finance. That's why he won the Nobel Prize. Or now Markowitz came first. Markowitz wrote his Nobel Prize paper in the late 50s. Sharp wrote his in the early 60s. I did a presentation this summer where I mentioned Markowitz. So I wanted to look and see how Markowitz was doing. He had just passed away. So he just passed away last summer. Really important person. Why did Markowitz come up with? Y'all heard of the efficient frontier? So we'll talk about the efficient frontier in here a little bit. So yeah, William Sharp, very, very important person. So he came up with capital asset pricing model. So he wrote this article where he talks about how many asset classes should you have. I'd encourage you to read this article. It's really old, but it's still pertinent today. We'll look at it. I want to actually look at it and see what he said. But he uses the word parsimony or parsimonous. It's a great word. You should work it into a conversation this week. A friend calls you and say, hey, I want to go out to eat. You say, no, I'm being parsimonious this week. Just see what they say. You know, start broadening your vocabulary for the interview. But what does parsimonious mean? You're just stingy. So with asset classes, we want enough, but no more. If 10 is enough, you don't want 11. If 10 is not enough, then you want 13. Okay, so you want enough, but not more. Why don't you want more? What USAA we had, I think we had 13 asset classes. 13, I just can't remember. It depended on the portfolio too. So, so if we have 13 asset classes, we have to either manage those or hire someone to manage them. So we outsourced a lot of ours. We didn't have international stocks internally, so we had to outsource that. So there's a few asset classes we had to outsource. So every asset class we outsource, I have to go hire a manager. We were interviewing 4 or 5 managers a week, so 200, 250 managers. That's a lot of time. I got to the point where I told them, don't even come to USA. It was a major hassle because I had to send poor Michael, who's our most valuable employee. I had to send him down to the lobby to pick these people up. I'd much rather him sitting there working on his computer because he was a really valuable employee. He had to go pick them up, and then we had to sit there and listen to them. I had to shake their hands, give them coffee and tea and all that. So I said, no more visits. We don't want to see you. We did everything conference calls. That way, if I had a really bad call, I just hit mute and I could go back to work. I could just ignore them. And then every once in a while, I'd jump in with a question, because there were some really bad calls. People, maybe they weren't bad, but it's just a firm I knew we would never hire. It just didn't fit what we were doing. So it's time consuming. What happens if I go from 13 asset classes to 14? Now I got to interview a whole other group of managers. It's very time consuming. And then once you hire a manager, now you got to do a contract with them. We had to send our compliance people to go visit their firm. And we had the best compliance department of all. This one lady I worked with, well, she was so good at her job. She would go visit these firms and tell them what they needed to fix. And they were like shocked. It was like, oh, we didn't know that. And she was like fixing their firms. That's a lot of time. It's very time consuming to do all of this stuff. So if you don't need 14, don't hire 14. If 13 is enough, that's all you need. It's a lot of work. But if you need 13, you need 13. Why do you need 13? Well, the key is, what does that extra asset class bring you? And there's really 3 things we think about: return, risk, and correlation. And probably the most important one is correlation. Well, adding that asset class provides some diversification to our portfolio. So why don't we just say stocks is one asset class? Well, US stocks are a lot different than non-US stocks. So breaking those between US and non-US stocks, that adds extra information. Why? Because US may be in a recession when Europe's not. Or the dollar may be weakening where the euro is strengthening. So we have that kind of diversification. Is diversification good? Yeah, it's wonderful. So that's the biggest one. But risk and return are also in there. So if you look at stocks in the United States, we have big companies and we have small companies. They're highly correlated. Having big stocks and big companies and small companies, your stock portfolio doesn't diversify very well. But large stocks have lower expected returns with lower risk. Small stocks have higher returns with higher risk. So they provide that kind of dynamic. We're going to talk about some other things, value versus growth, and those type of and cyclical versus defensive. How do you break this up? And that's what William Sharp is asking. Is there an ideal number of asset classes that's going to give you the best answer? So you don't have to do a lot of extra work. You're going to cover the world really, really well. Sharp has several articles that are just really, really exceptional. So here's where he talks about this parsimony kind of thing. And what he focuses in on is R squared, which you had in your stats class. You all had stats, haven't you? Did you know that it was your most important class when you took it? Did they tell you it was the most important class? Do you know the formula for standard deviation off the top of your head? You should. You know the formula for beta off the top of your head, and the formula for correlation. You should off the top of your head. You shouldn't have to look it up. Most important class. So R squared. What did R squared tell you? Y'all remember that statistic? What is R squared? It's correlation squared, but what is R squared? So you need 2 data series. So R squared is telling you how much of the volatility of one data series can be explained by the volatility in the other data series. If you get an R squared of 100%, means that when one is above average, the other is above average. When one's below average, the other's below average. That's a R squared of 1%. And move R, if one's above average, the other's below average. You can exactly predict one versus the other. So that's what R squared is telling you. It's talking about their averages and how they move versus the average. If they're both above averages at the same time, and they're both below the averages at the same time, the R squared is 1%. If it's the exact opposite, one's always above and the other's below, that gives you an R squared of 1%. This 100%. Let's see. You remember correlation is a little different. If they're both above the average at the same time and both below average at the same time, your correlation is going to be what? Positive 1. If one's above when the other's below, and the other's below when the other's above, what is that correlation going to be? Negative 1. But correlation is, R squared is correlation squared. So when you square the negative 1, what do you get? 100%. All right. So what R squared is telling you is, can you explain this? What's going on over here? All right. So what William Sharp is trying to do is saying, you take any portfolio and you take these 13 asset classes, how much of that portfolio's risk can you explain? So if you get an R squared of 40%, do you have enough asset classes? Probably not. You're only explaining 40% of the risk. If you get an R squared of 98%, do you have enough asset classes? Yeah, you may have too many. Okay, does that make sense? All right. So it's a little tricky. What if you get an R squared of 98%, but your correlation is negative 0.92? That's probably not going to happen what he's doing. So that's pretty unlikely. So he's kind of ignoring that, but that would be bad because it's explaining your portfolio, but exactly the opposite. So that would be good. So he's kind of assuming the R squared is 98%, the correlation is positive 0.9, whatever. Right, so he's using R squared. Now he's using this formula, but you don't have to do that. What we did at UTSA is we use Solver in Excel. I don't know if you use Solver in Excel, but Solver in Excel is for non-statisticians that are too lazy to set up the quadratic formula. So we can just do it. We can just tell Solver to allocate to those 13 asset classes, give me the highest R squared possible. He uses formulas, which is fine because he's more mathematically gifted than I am. So what he's trying to do is maximize that R squared, but using as few asset classes as possible. So if he could use 2 asset classes and get an R squared of 98%, he's done. But if he only uses 2 asset classes and only get 50%, he's going to add more. So he tried it with 10, he tried with 11, with 12, with 13, with 15, he kept trying. And this is what he came up with. Here's his list. He has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I wish he would rewrite this article because I'm very sure his list would be very different today than it was back then. Well, so let's say you have 13, your R squared is 98%. And then you add a 14th. Your boss says, hey, what about real estate investment trust? What if we counted that as a separate asset class rather than just being a small cap stock? You run it, your R squared goes from 98 to 98.1. You tell your boss, yeah, it's not worth it. Doesn't add much explanatory power at all. That's just not enough for us to be messing with it. So he says bills. I'm not going to call it bills. What I call it, I'm going to call it cash and cash equivalents. I'm not going to call it bills. Why do you call it bills? You're talking about T-bills. When the government borrows short term. The next one he does, we will use this term, intermediate term, but he has intermediate term government bonds. Why doesn't he have intermediate term corporate bonds? We'll talk about that as well. Intermediate term versus what? Short term and long term. Government bonds, what does that mean? High quality or low quality? Very high quality. He has corporate bonds, but he only has one category for corporate bonds. I'm going to disagree with him on that. We're going to break out corporate bonds into high quality, medium quality, low quality. Low quality, we're going to call them junk bonds or high yield bonds. We're also going to talk about short term, intermediate, and long term. We're also going to break out municipal bonds. Why might we do that? Municipal bonds, when you loan to state governments and cities, well, they're often what? Tax free. They're tax-free, we gotta treat them differently. So we're gonna break ours out a bunch more than he does. He's breaking out mortgage backs, we're definitely gonna do mortgage backs. We're gonna talk about convexity. We haven't talked about convexity, extremely important concept there. So we will break that one out, but it's only one category. Then he gets to the stocks. Large capitalization, what does that mean? Big companies like Apple, trillion-dollar companies, large capitalization. And then he breaks it between value and growth. We're going to do that as well. We're talking about what's a value stock, what's a growth stock. So I'm heavy in the value stocks right now. I look like a genius in 2022. I look stupid this year. Why did I like value stocks? Why do I still like value stocks? We'll talk about it. Value versus growth. Then he does mid-cap stocks, medium-sized companies. We're going to do mid-cap and small-cap as well, but he doesn't have one of my favorite asset classes of all is small-cap value stocks. Why doesn't he break out small-cap between value and growth? He could do that. He decided not to. I think it's because the data didn't exist. And the data does exist today. And what we're going to talk about, one of my favorite of all, I've been wanting to set up this portfolio for some time. I just have the time to do it. But small cap value, a value stock we'll talk about is a cheap stock, and it's cheap because it's a really troubled company. These are companies that do horribly in recessions because they're probably going to go out of business. So they look cheap, but they're cheap for a good reason. But what Cliff Asness says, one of my favorite writers, is small cap value is over the long term, it's just done great. It's been the best asset class out there. Recently, it's struggled. What Cliff Asness has said is small cap value still works. You list all the value stocks and you kick out the worst ones, the low junk ones, which is really easy to do on Bloomberg, because Bloomberg has a quality rating that is very, very, very strong. And you really could take all the small cap value stocks, rank them by quality, and kick out the worst ones. I think you would have a really killer portfolio, but I haven't set it up yet. One of these days, I'm going to get around to doing that. He doesn't break them out. We do. We will break out small cap. I think he would today. He has non-US bonds. We're going to talk about them, and then we're going to kick them out as an asset class. I do not consider non-US bonds, and you'll see why. The main reason is currencies. Bonds are low risk, stable assets. Currencies are very volatile. At USAA, we talked about adding a non-US bond fund, and the head of department, Cliff, says, I don't want to do it because our member is going to see it as a low risk portfolio, and it's going to be all over the place because of currencies. And we don't want to do that. But he has it in there as one. Then he does something really bizarre. The non-US stocks, he has Europe and Japan. Now, why did he do that? Because when he wrote this, Japan was over 50% of the stock market outside of the United States. What has Japan done since then? It fell like 85%. Now it's come back really strong. If you've had Japan recently, you've done really, really well, but it fell dramatically. It was at 40,000 and dropped down to like 6,000, 7,000. So in 89, Japan was just a place to be. It was doing really, really well, and then it crashed dramatically. So that's why he broke it out. We're going to break it out differently. We're going to do developed markets, which would include Europe and Japan and Australia. We're going to do, what do y'all know what the second one is? We have developed markets. Developing, we're going to call it emerging markets. And then what's the third class? We call it frontier markets. Okay, they're kind of a wild, you're like going for it. I think when I retire from UTSA, I'm going to move to Botswana. It's one of those frontier markets, but it's a really well-managed country, good government. It just I don't know what it looks like climate-wise. Check that out. But I would love to go there. It just looks like a really cool country. If I were your age, I'd be almost tempted to do it at 22, because frontier markets, if you find a good frontier market, the challenge with them is the knowledge base. You got to understand what's going on the streets. And so, yeah, I think I'd almost, and Botswana, English is one of their official languages. I'm not going to learn a new language. There's no way. I'm too old and stupid to learn a new language. But I think that'd be pretty cool. I think, some of y'all might think about that. I read an article, a guy who's doing investing in Iraq. Where does Iraq fall, do you think? That's a frontier market. It's a pretty scary market, but he's having great success because he said there's some small businesses there that are very trustworthy. They know what they're doing. they're making good return, so, but how can he do that? Because he's on the ground there learning that. So we're gonna break it out a little differently than he does, but I still think today he would probably be developed emerging in Frontier if he did this today. So that's what he came up with. And so what he did is went out to a client, and it's called the Trustees Commingled Fund. This is just a fund. It's all commingled. We'll talk about commingled versus mutual funds versus separate accounts. So if it's a commingled fund, what does it mean? It's essentially a mutual fund where a bunch of people are investing in it, but the only people investing are large institutional investors. It's not a retail product. It doesn't have a ticker. You can't trade it on the stock market, but it's like a mutual fund. And he took his, did I say 12 asset classes? And he ran a regression. And he said, allocate to these 12 asset classes and give me the R squared, how much it explains this commingled trust. Okay. And the first time he ran it, he got an R squared of 95%. That's pretty good, but there's a big problem with it. When you add up all of his allocations, he only gets 73%. What do you think he'd want to get? You allocate 73% of your money. The obvious question is, where's the other 27%? Right? Is it just floating out there making 0%? That doesn't make any sense. So he ran it again, and he got 100%. But he has another problem. Y'all notice any strange numbers up there? He's putting 110%. He's shorting bonds. You really short bonds 68%? That'd be a pretty wild portfolio. So he runs it a third time. What do you think he does the third time? He adds up to 100%. What else did he do? No negative allocations. What happened to his R square? Fell down to 92%, but he said that's good enough. 92 is good enough. So what is this mutual fund that he's looking at? Well, it's 70% value stocks and 30% small caps. And if you run it today, probably what is it? It's probably 70% large cap value and 30% small cap value. So if he had broken out small cap growth and value, you'd probably get his R squared up at 93, 94. Because that's probably what they're doing. Most value managers are value everywhere. I mean, there's no way they're going to be value large cap and everything. What do you call it when you're both value and growth? You don't know that term? That's called core. If you're core, you're doing both. So it's unlikely they're large cap value and small cap core. So they're going to be large cap value, small cap value. So there's one error with this model. If he had added small cap value, he would have gotten much higher R squared. All right, so let's stop it there. Any questions